Welcome to Books in Sum, your go-to for bite-sized book summaries.
Outsmarting the Crowd by Bogumil K. Baranowski. Bogumil K. Baranowski's book, Outsmarting the Crowd, is an excellent resource for new investors because it defines company stocks and details the steps necessary to buy them. That investing won't make you rich overnight, and why successful investors are picky and never gamble with their money are covered as well. Many businesses offer stock to the public as a way to attract investors and provide capital for day-to-day operations. This is a tactical choice that should be made in light of the company's current and projected financial situations. As businesses expand, so do their funding requirements. Investors can raise capital by taking the company public, dividing it into shares that can be traded on the stock market, or by borrowing money from a bank. Keep your emotions out of investing and focus instead on being logical and timing your moves. Don't give in to your feelings if you're a Starbucks stockholder and you see a 10% drop in the company's valuation in the news. Timing opportunities typically present themselves when the financial markets are being driven by extreme emotions. During the dot-com bubble of the early 2000s, for instance, investors went crazy for internet startups like Pets.com and Webvan, despite the fact that they had no business models, generated no revenue, and were doomed to fail. Even stable, profitable businesses saw their share prices drop during 2008's global financial crisis. Discipline, patience, and only investing money you don't need to spend are the keys to financial success. Investment returns can take months or even years to materialize. Discipline is difficult because it requires overcoming the anxiety that comes from thinking you might be passing up a lucrative opportunity. It also means not risking funds that you might need in the near future. Good investing requires expert knowledge and a commitment to lifelong learning. Warren Buffett frequently refers to the concept of a circle of competence, which suggests that one should focus on and excel in one's core strength. Knowledge and the Pareto principle are the two most crucial concepts discussed in this article. According to the Pareto principle, only 20% of factors have a significant impact on the whole, so it's important for investors to zero in on the metrics that matter most to them and ignore the rest. This is due to the fact that only a select few can truly drive a stock's price higher, and that investors with insider knowledge have an advantage over those who don't. Reading on a consistent basis is as vital to investment success as learning from one's own mistakes. Making wise financial decisions requires keeping things straightforward and selective. For sustained attention, remember the Pareto principle's 80/20 rule, which states that 80% of effects come from 20% of causes. Warren Buffett's investment philosophy is summarized here in 4 key points: knowledge of the company, future potential, confidence in management, and cost. Successful investors know what questions to ask when evaluating a stock, such as whether or not it is a good time to buy, whether or not the company's pricing power makes it a desirable investment, and so on. Lastly, investors should avoid businesses that show a lack of adaptability, as doing so can result in significant financial losses. The most critical information presented here is that the financial markets are vulnerable to sudden drops and spikes caused by the overexcitement and exaggerated disappointment of investors. The extreme volatility of the financial markets is fueled in part by the fact that investors today hold onto their stocks for extremely brief periods of time. Investors who are in it for the long haul don't sell on the daily gyrations of the stock market. Instead, they should allow their portfolio companies ample time to implement strategic plans for long-term success. When people are in a state of panic and want to sell at any cost, astute investors can capitalize on the situation. Smart investors prioritize safety when purchasing stocks, so it's crucial to buy low, reduce expectations, and diversify holdings. In a world where you can't and shouldn't try to predict the future, cheap purchases are essential, but so are realistic expectations. You shouldn't just cross your fingers and hope for the best. You should instead proactively build scenarios that don't count on an organization defying all odds. One company that has proven to be profitable in spite of difficulties is Tesla. Only if the company has a strategy for building a healthy business on the basis of modest, long-lasting success would a shrewd investor consider purchasing shares. It's crucial to spread your stocks around when you first start investing. Building a portfolio and amassing wealth takes time, but with careful planning and a level head, anyone can achieve their financial goals. Practical guidance: admit defeat when you fail. You can still make a profit with your investment portfolio even if you make a few bad bets. Thus, acknowledge your shortcomings and take them as opportunities to grow.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.